Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Japan's lost decade was a period that lasted from about 1991 to 2001. The decade saw significant slowdown in Japan's previously bustling economy. The economic slowdown was caused in part by Bank of Japan's hiking interest rates to cool down the real estate market. Now consider this. MSCI Japan index has produced more than double the return of the MSCI China index over past 3 decades. Japan has returned 164% against China 75%. In fact, MSCI China has had the poorest returns amongst emerging market indices over the period. Until a few days back, the index was still actually below its starting level, and even with the dividends reinvested, it had only returned 1.9% over 30 years. But that was not the case until early 2021. All it took was a regulatory crackdown and increased government intervention in the markets. China lost almost all its gains in the stock markets, especially in the massive tech stocks in the sell-off of late 2021. Now, was this expected? Aren't stock market returns supposed to mirror the performance of the economy, even if with a lag? Well, that's not always the case. Allow me to debunk some myths. Hi, I'm Tanushree Banerjee, editor of Equitymaster's Blue Chip Recommendation Service Stock Select. Welcome to Safe Stocks, where we discuss ideas to create and preserve wealth in the safest businesses. If you haven't subscribed to Equitymaster's YouTube channel yet, please do so and click on the bell icon to get notifications for my latest videos. Now, the chart here shows that the best performing stock market in the 20th century was Australia, closely followed by Sweden. Neither had anywhere near the best economic growth rate. I'm referring to the real per capita GDP growth over that period. Why was this? Clearly, returns in a stock market reflect the returns of the stocks listed in that market. The quality of those businesses, valuations, cost of capital, regulatory environment, and economic megatrends all play a part in the stock market returns. The stock markets that have a history of relatively poor capital allocation and government interference typically offer mediocre returns, whereas those with better governance, fewer state-owned enterprises, and healthy access to capital have done materially better. Therefore, large parts of the Chinese stock market were of no interest to foreign investors for a long time. The major listed stocks there were state-owned banks, telecoms, utilities, which were known to lack transparency. There were heavy industry and mining stocks, so problems related to governance and overcapacity, and the real estate companies, again problems of overcapacity, opaque balance sheets, and government interference. So what happened subsequently was that investors were left focused on the internet platform and higher-end manufacturers and technology stocks. These Chinese companies attracted so much capital and grew so big that they cornered a huge proportion of the Chinese stock markets by 2020. And then came the barrage of regulatory embargoes. Starting 2021, the Chinese government started banning or imposing regulations on tech businesses that almost made them unviable. This caused foreign investors to reevaluate their exposure and pull back capital from Chinese equities. Now the question arises whether even India could witness a similar market correction. First of all, with its private sector banks and enterprises being allowed to operate with less government interference, India has really lived up to the emerging market promise so far. More importantly, the stocks with the largest weightages on the Sensex and Nifty currently do not have as much sector concentration as in the US or Chinese stock markets, where the tech behemoths dominate. But that said, a lot of money has flowed into existing and newly listed tech stocks in India in recent months. Many of the stocks are undeserving of the capital, and that is where the bubble could burst. So, as investors, we must be careful of these pockets of risk. A lot of disruptive businesses may promise exponential growth based on a number of factors like the visitors to the portal, or may seek steep valuations based on what they call the gross merchandise value. But we must keep in mind that a first mover advantage could only last so long, and once competition catches up, the exponential growth numbers may not be sustainable. Just as there is a wave of new listings in the disruptive tech space, there are also plenty of companies that fail to meet any quality metrics. yet they are able to fetch astronomical valuations. Take the fintech ecosystem for instance. There are a variety of companies getting listed from segments like payments, insurance, broking, etc. Now these companies do not just have competition from the new age players, but they are also competing against the incumbents, that is the banks that have adopted technology in a big way. So with stiff competition and little differentiation, the path to profits is a tough one. What is most worrying is that despite low profits, some of the segments have seen a flood of money from VCs and private equity investors in the past year. The fintech sector especially is flooded with unicorns, and I won't be surprised if many of them do not make it to the other side of the market bubble. So when you are aware of such downside risks in the stock market, you should be extra cautious in spotting the opportunities and picking only the best ones. Hope you like this video. Stay tuned for more such videos on the safest and most appealing permanent wealth creating stocks. Thanks for watching.